Buying a house for the first time is exciting, but it can also be intimidating and overwhelming. And if you don't know a lot about the process, you might even make a few rookie mistakes. But while mistakes are common when you're navigating new waters, the ones you make as a first-time home buyer can be costly. So today we're going to look at a few of these, plus explain how you can avoid them. So the first mistake is not educating yourself. Now, obviously, when you go into the mortgage process, nobody expects you to know everything there is to know about different types of loans. But at the same time, you really shouldn't go into a meeting with a mortgage lender having absolutely no clue about the process, because then there's the risk of information overload. So even if getting a mortgage and buying a house is still a few years into the future, take the time now to review home loan types and have a general idea of your options. And this is beneficial because you're able to learn about credit score requirements and down payment requirements early on, which can help you prepare. You can also use this time to research the different documents you'll need when applying so you can organize your files in advance. And if you're self-employed, make sure you research and understand what lenders will expect from you, because the process is slightly different. Also, check your credit report and score as soon as you start thinking about buying a house, at least a year in advance, because honestly, your credit history and score, it might not be as good as you think, and if that is the case, this allows enough time to clean it up. Another mistake is shopping for a house before getting pre-approved. Now, there is no rule that says you have to be pre-approved before you start house hunting. However, this does serve to your advantage, because without a pre-approval, there's really no way to know how much you can afford to spend on a house, and you don't even know if you qualify. A pre-approval can remove some of the guesswork, and when you know how much you're able to spend, you avoid falling in love with a house outside of your price range. Plus, a pre-approval is one of the biggest signs that you are a serious buyer. And once you get this letter from your lender, sellers and real estate agents, they will have more confidence in your offer. Now, one thing to keep in mind is that there is a difference between being pre-qualified and being pre-approved. Now, some people will use these terms interchangeably, but a pre-approval does carry more weight. With a pre-qualification, you'll fill out a simple online form and provide information about your credit score and your income. But the lender doesn't verify this information, and based on what you provide, they'll estimate how much you might be able to borrow. A pre-approval, however, takes it a step further and involves the lender actually verifying your income, employment, debts, and other assets. And because of this extra step, a pre-approval really gives you an edge over the competition. Another mistake is not shopping around. Keep in mind that mortgage rates can vary from lender to lender, so it is so important that you shop around and you get multiple quotes. And not only do rates vary, but also lender fees, and the amount that you're charged can greatly affect your closing costs. Now, ideally, you want to rate shop within a 14 to 45 day window, preferably within 14 days. And you want to get at least 3 mortgage quotes, and you can contact your personal bank, credit unions, online banks, and mortgage companies. Now, there's often concerns about multiple inquiries when it comes to rate shopping, but the good news is that credit scoring models, they are designed to recognize rate shopping behavior. So those multiple inquiries will only count as one on your credit report when they take place within a certain window. And rate shopping may not seem like a big deal, but just to give you an example, if you were purchasing a $300,000 house, the difference between a rate of 3.25% and 3.50% is about $40 a month, and over the course of that loan, you end up paying an additional $14,000. Another mistake is forgetting about closing costs. Now, a lot of people going into the home buying process realize that they will have to save for a down payment because many mortgage programs do require one. But that is not the only expense you are responsible for. You're also responsible for your closing costs, which are lender and third-party fees. Now, while a lot of mortgage programs require a minimum down payment between 3% and 5%, closing costs can range an additional 2% to 5% of the loan amount. Now, fortunately, there are ways to deal with this extra expense, and one thing you can do is ask your lender about closing cost assistance. And one option that might be available is that your lender, they might give you a credit towards your closing. But the catch is, in order to get this credit, oftentimes you will have to agree to a slightly higher interest rate. Also, depending on the amount of available equity you have in the house you're buying, you might be able to roll the closing costs into your new mortgage, and some programs, they even allow sellers to contribute a percent to your closing. Another mistake is buying too much house. Being house poor is not fun, yet a lot of people find themselves in this situation. This refers to spending so much of your income on the mortgage that you have nothing or very little left for anything else, and this can happen when you buy at the top of your budget. One important thing to keep in mind is that just because your mortgage lender approves you for a certain amount doesn't always mean that you can afford to spend that much on a house. And I know that might sound confusing, but understand, when the lender determines how much you can afford to spend, they will use your income plus information about debt payments listed on your credit report to gauge this. But like a lot of people, you have monthly expenses that don't appear on your credit report. For example, your lender doesn't know how much you spend on insurance or daycare each month. And if you're spending a lot on these expenses or in other areas, you probably need to spend less on the housing side. So when a lender approves you for a certain amount, don't get immediately excited if it's more than you expected, because you really have to be honest and realistic about your affordability. And my recommendation is really to play it safe, and if possible, spend less than your pre-approved amount, because the less you spend on that house payment, the more cash you will have for savings and experiences. Another mistake is emptying your savings account to buy a house. Now the reality is, between your down payment and your closing costs, buying a house, it can take a chunk of your savings. But even though some mortgage programs don't have cash reserve requirements, which are funds you have in the bank after closing, it is always smart to have some available cash or liquid funds available after you buy a house. Now there really isn't a magic number to have available, but you never want to have zero funds in the bank. And honestly, in a perfect world, your down payment fund, it should really be separate from your emergency fund. But I realize that not everyone's in a position to save separately, so everything might be in one pot. And if you don't have these accounts separate, one thing you might do is think about having at least 3 to 4 months of mortgage payments in reserves after closing. If you're thrown some financial curveball shortly thereafter, that can really help keep your head above water. Another mistake is applying for new credit before closing. Now understand that there are numerous factors that influence a lender's decision to approve you, with 2 of those factors being your credit score and your debt to income ratio. And if you're not familiar with the term debt to income, this is the percent of your monthly gross income that goes toward debt payments. And what some people don't understand is that getting new credit can cause your credit score to drop by a few points. Plus, it can increase your debt to income ratio, which is not good, because depending on the circumstances, that increase can actually jeopardize your mortgage loan. So it is so important that you do not finance anything and you do not get into any additional debt until after closing. Now, if something happens, maybe your car dies and you need another one and you don't want to touch your cash because you're reserving that for your mortgage related expenses, before you get into any new loan, make sure you talk with your mortgage lender and make sure this is okay and that it will keep your loan on track. So that's all that I have for you guys today. Thank you for watching. I really hope that you enjoyed this video, and if you did, please give me a thumbs up, and if you haven't already, definitely consider subscribing. Here we talk a lot about personal finance, so if you like videos like this, I do post every weekend and sometimes during the week. Thank you again for watching, and I'll see you in a few days.